We're at the Ibiza Beach Club, the music's playing. Let's figure out what this question's really asking us about. It's asking, what was the cash paid to suppliers for inventory purchases? So we know we need to do something on the cash basis, and if we read through it, right, well, it's giving us accrual-based items because there's beginning inventory, ending inventory, there's cost of goods sold, and then there's also accounts payable, beginning and ending balances, right? So we are going from accrual to cash. Now, when you're going from accrual to cash, or if you're going from cash to accrual, the balance sheet approach is very helpful and it simplifies this topic. So the first thing we need to do is figure out how much material the company purchased during the year. So we're going to start by preparing the inventory roll forward because that will help us figure out how much material was actually purchased. So as you can see right here's our roll forward. It's going to be beginning inventory plus material purchases because that's what increases our inventory balance. And as we can see off to the right, the journal entry, when we purchase things on credit with our suppliers, well, we capitalize those material purchases into inventory. So that's why the debit is to inventory. And then since we haven't paid anything yet, we need to record that accounts payable, and that's going to be the credit. So then we have to think about what would decrease our inventory balance. Well, we know that that's going to be cost of goods sold, which is only recognized when the company actually sells the good or service and they recognize the revenue, right? Under the matching principle, we cannot recognize the cost of those materials or goods until the revenue is recognized. And then ultimately that takes us down to our ending inventory. So let's punch in what we have. So for beginning inventory, the question gives us that it's $200,000. They also tell us ending inventory is $150,000. Now in this situation, right, because we're going from accrual to cash, they give us cost of goods sold, and that is $1,200,000. But that's going to be a negative number, right? Because that is going to reduce inventory. So now all we need to do is solve for the material purchases. In order for this roll forward to actually balance, that means that material purchases were $1,150,000. Now that's not going to be the correct answer, right? Because when we purchase it, that doesn't mean we've actually paid our suppliers, because again, those things go into accounts payable and we usually pay off our payables, 30, 60 days later. So what we need to do now is use that information, plug it into our accounts payable roll forward, and then we'll be able to solve for payments to suppliers, right? To get that cash amount. So for accounts payable, the roll forward, right? The balance sheet approach, it's very similar to inventory. Just in this case, we have to think about what increases accounts payable and what would decrease it. So material purchases, that increases accounts payable, right? Look at the journal entry we recorded when we purchased that material. We had the credit to accounts payable, that's increasing the liability. It's only going to be decreased when we actually pay our suppliers, that cash outflow, right? And then what's left is ending accounts payable. So let's plug into the roll forward what we know. So beginning accounts payable, the balance is $300,000. The question gives us that. And then material purchases, well, we just calculated that in step one from our inventory roll forward. So that's $1,150,000. And then payments to suppliers, well, that's what we're solving for. So leave that blank. And then you have ending accounts payable. The question tells us it's $200,000. So there's different ways you can solve for the payments to suppliers, but the easiest way to do this is just take the beginning accounts payable balance, add in material purchases, and that takes us up to $1,450,000. And then if we have to get down to ending accounts payable of $200,000, well, we know that's going to be a decrease of $1,250,000. So $1,250,000 is going to be the correct answer. And real quick, look at the journal entry, right? That is what we would record when we actually pay our suppliers, right? We're removing the liability, which is a debit to accounts payable, and then there's that credit to cash for the same amount because it's a cash outflow. So just remember this experience at the Ibiza Beach Club, blasting the music, and then you've got the balance sheet approach. And remember, just because we're purchasing material in the inventory roll forward, that doesn't mean we've actually paid our suppliers yet. So for questions like this, you may need to calculate the inventory roll forward and the accounts payable roll forward just to figure out what payments to suppliers were.